Today, I'm going to introduce you to Warren Buffett's secrets to identifying and investing in company stocks that made him super rich. Today, we're analyzing Co-Diagnostics ticker symbol CODX. Yes, FinViz lists Co-Diagnostics earnings per share this year is up by 510% with a gross margin of 83%. But does this stock stack up to a Warren Buffett type analysis? This series will take you through a Warren Buffett type discovery of stocks to discover if they have the potential to make you super rich. Warren Buffett, worth $97 billion, is the most successful investor in America and the fifth richest man in America behind Jeff Bezos, Elon Musk, Bill Gates, and Mark Zuckerberg. Today, I'm going to share Warren Buffett's stock evaluation techniques. I picked this ticker, CODX, because it is a potential investment that I am analyzing for my own portfolio. For years, I worked with company CFOs and financial consulting teams, helping Fortune 500 companies to determine where they were making money. And during this time, learned more about analyzing financial statements. Later, when I learned of the book, Warren Buffett and the Interpretation of Financial Statements by Mary Buffett and David Clark, I realized that this book shared the secrets I had been missing: how to identify companies with a long-term, durable, competitive advantage. These investments that can make you super rich over the long term. The book teaches how to identify those stocks that over the years have the potential to deliver greater and bigger profits. For your convenience, I have provided a link to this Buffett book, Warren Buffett and Interpretation of Financial Statements, in the description below. This is a detailed video which could be consumed in chunks, so I added chapters in the description below as well. Here you can pick up where you left off or review the key portions. To give you a brief introduction to Warren Buffett's techniques, he originally learned about value investing from Benjamin Graham, who seeked only to invest in a stock for 2 or 3 years. But then Warren discovered the wealth-creating ability of a company that possessed a long-term competitive advantage. He discovered that the longer you held these types of companies, the richer you became. All he had to do was to buy the company stock at a fair price, not particularly a bargain basement price. Mary Buffett, Warren Buffett's daughter-in-law, captured the investor's techniques along with David Clark, who was an investing student of Warren Buffett and kept notebooks filled with Warren Buffett's investing advice. The book served as a short, easy-to-use guide to evaluating a prospective stock's financial statements while leveraging Warren's set of tools. Warren Buffett first advises you to understand the best you can what a company does and its potential competitors. Studying 5 or even 10 years of a company's financial statements will also provide insight into trends, whether in a positive or negative direction. So keep in mind that this approach cannot be successfully applied to OTC or pink sheet companies that provide little financial reporting and that lack the oversight of a company that is listed on a major exchange. But we can use Buffett's approach to a company like Co-Diagnostics that is a micro-cap company listed on the NASDAQ exchange and is currently in the $10 to $11 range. So let's dig into Co-Diagnostics details to learn if this stock has the potential to make an investor super rich. This is Lynn, and welcome back to this first stock analysis in the Warren Buffett way. But first, remember, I am not a financial advisor, so this is for entertainment only. But it would be great if you could give this a thumbs up in return for all my hard work analyzing the CODX ticker, which took me many days to complete. So let's get into it. First, we need to identify companies with a competitive advantage in an industry or region. Co-Diagnostics offers the Co-Diagnostics SARS-CoV-2 direct saliva testing kit. This is an extraction-free test versus, for example, a blood draw test. The patient's saliva can be self-supplied, then heated and combined with PCR reagents. Then they can run the reaction to the test. Then CoDX has more recently developed a Logic Smart SARS-CoV-2 DS real-time test. This test targets two genes within the COVID-19 virus. Co-Diagnostics believes they can identify any COVID-19 strain. They offer PCR testing results in less than 30 minutes through an at-home self-test. For the test, the patient spits into a tube. The patient puts the tube into a 4.5 by 4.5 cube machine, which a smartphone activates. Within 30 minutes, the patient receives test results sent to the phone. For Co-Diagnostics, the COVID-19 virus was the catalyst for creating this type of test over the past year. And you will soon see that versions of this test to date have enabled Co-Diagnostics' big bump in positive financial results. Co-Diagnostics is based in the U.S., but in March of 2020 announced their joint manufacturing venture in India, CoSara Diagnostics, had become the first Indian company to be licensed to manufacture a COVID-19 PCR test. This was a big deal and has provided a great boost to Co-Diagnostics revenues, as you will soon see. So now that we know a little about Co-Diagnostics, let's next use Warren Buffett's approach to financial statements interpretation to determine if Co-Diagnostics may have a long-term or durable competitive advantage, if it qualifies as a company that can make you super rich. Over the past year, CODX has had a 52-week price range of $7 to $20.69. Like many microcap companies, Co-Diagnostics stock was affected by the overall pullback in price that you can see in the Russell 2000 stock chart. But can we expect this price slide to turn around in the future? Buffett recommends that when identifying an exceptional company with a durable competitive advantage, we search for an exceptional company with a unique product or service. Warren Buffett's unique product examples were Coca-Cola, Pepsi, Hershey, Procter & Gamble, and Altria. A unique service provided by companies such as Moody's Corp, H&R Block, American Express, and Wells Fargo. Or we can search for a company that is a low-cost buyer or seller of a product or service that has consistent public need. Low-cost providers include Walmart and Costco, where their big volume makes up for a decrease in margins. This is where we can find a company with the potential to make you super rich that may have a durable competitive advantage. So far, Co-Diagnostics appears to have a somewhat unique product and service. Warren Buffett found that some manufacturers, such as Coca-Cola, are truly exceptional, as Coke has been selling the same product for 122 years. This is a fantastic business because they don't need to spend millions of dollars on research and design or R&D. But how can we find out more about Co-Diagnostics and if this company has the potential to make you super rich? We are now going to follow Warren Buffett's analysis outlined in the book. Warren Buffett dives into the financial statements where he looks for consistency in gross margins, a low amount of debt, consistent earnings, and a consistent growth in earnings. Buffett also searches income statements for excellent profit margins, great returns on equity, and a consistent direction of earning. A company's balance sheet will reveal how much money is in the bank and how much is owed. Then subtracting the two, and we get the company's net worth. Remember that company balance sheets are usually generated for the end of the year and the end of a quarter. The company's cash flow statement will reveal money being spent on capital improvements, bonds, and stock repurchases. I usually use Yahoo Finance statements at yahoofinance.com and then do a quick double check against the company's filings at sec.report to ensure that the Yahoo numbers are updated and complete. A company's income statements include revenues, expenses, and profit loss. The goal is to dive into this data and uncover businesses with a durable competitive advantage versus a mediocre business. Then we want to buy businesses with a competitive advantage at a fair or better price. The outcome is to meet Buffett's goal to make us super rich. If the company meets Buffett's requirements, is held for the long term, and maintains the advantage. How to identify a business with a durable competitive advantage from its financial statements? Let's apply Warren Buffett's techniques to Co-Diagnostics' income statement. Remember that revenue equals the amount of money coming in the door during the financial statement's yearly or quarterly period. In looking at Co-Diagnostics' income statements since 2017, we see a steady growth of revenues each year from $7,662,000 to $74,554,000 in 2021, and trailing 12-month revenues of $96,347,000. This shows great positive progress in this area. Remember that I'm adding 3 zeros to all the numbers you are seeing here on the screen, as the numbers are listed in thousands. Next, we determine the profit loss for Co-Diagnostics by deducting the company's expenses from the total revenues. The company's total expenses were $4.5 million in 2017, growing to $32.8 million in 2020. This means the company's net profits in 2020 were obtained by taking the $74.5 million of revenues and subtracting the $32.8 million of expenses to realize $41.6 million of net profits. Remember, Buffett teaches also that controlling expenses are key to enabling a company to make higher profits, and that this means controlling company expenses and spending less. I've certainly found this all to be true in my personal life. First, to find out more if this is a company that can make us super rich, we need to locate Co-Diagnostics' cost of goods or cost of revenue if the company is providing a service rather than a product. We find this by looking at the cost of goods or services subtracted from the total revenue, equal the gross profit or loss. For the CODX ticker, we look at the cost of revenue, which was $16,591,000 in 2020. Then we calculate the gross profit margin by taking the gross profit divided by the total revenues to obtain the gross profit margin. For CODX, we can see that the gross profit has been growing steadily each year since 2017. In 2020, the gross profit was $57.9 million divided by total revenues of $74.5 million equals 77.7%, which I rounded to 78%. This is excellent. Companies with great long-term economics have consistently higher gross margins and a competitive advantage. For example, Warren Buffett described Coca-Cola's average gross profit margin as 60% plus. Moody's, the bond rating company's gross profit margin, was 73% plus. Microsoft's was 79%, and Apple's was 33% at the time the book was written. These gross profit margins were compared to companies in highly competitive industries, such as United Airlines with a gross profit margin of 14%, General Motors with 21%, and Goodyear Tires with 20%. In reviewing all the numbers so far, Co-Diagnostics looks like a winner with a 78% gross margin. This is a good first step to discovering if CODX has the potential to make you super rich. Before we move on, if you haven't yet, please give this video a thumbs up and subscribe for more videos in this series. Next, Buffett described killers of high gross margins when companies have high operating expenses such as high R&D or research and design costs, high sales and administrative costs or SG&A, high interest costs on debts. These operating expenses are totaled as operating profit loss expenses. Co-Diagnostics operating expenses have grown each year to $16,268,000 in 2020. Co-Diagnostics expenses were $16,268,000 in 2020, and the gross profit was $57,961,000. Approximately 28% of the gross profits were expenses, which was a huge improvement over their numbers in 2017. Fortunately, the company's gross profits are increasing steadily as expenses become a smaller ratio. Buffett explains that keeping consistent expenses in the above areas are very important. Companies without a durable competitive advantage suffer from intense competition and a wild variation in their SG&A costs as a percentage of gross profit. Buffett's book described the example of General Motors over a 5-year period going from spending 28% to 83% of gross profits on SG&A costs. Ford over the same period was spending 80% to 780% of gross profits on SG&A costs, which meant that Ford was losing money like crazy. When sales and revenues fall, but SG&A costs remain the same, this eats into the company's profits. So let's check our example company. Clearly, CODX SG&A costs were massive, with $3.5 million in 2017 compared to a mere gross profit of $7,360, and with a very poor ratio all the way through 2019. The ratio for 2020 was a great improvement, with 22% SG&A costs as a percentage of the gross profit of $57.9 million. These numbers clearly don't reflect the excellent multi-year low ratios that Buffett requires, but seem to be going in the right direction for now. The recent trailing 12-month numbers reflected SG&A costs as a 26% ratio to the $80.4 million in gross profits, which is reasonable. A durable advantage competitive company has low SG&A costs per Buffett, who explained that a ratio under 30% is fantastic. So with Co-Diagnostics 26% SG&A to gross profits for the trailing 12 months, this is a good improvement. But the company is missing the mark of multi-year ability to keep ratios low. Buffett explains that there can be some good companies that could have SG&A expenses in the 30% to 80% range, but a ratio of 100% or more means a company is in a highly competitive environment. The Buffett book shared that Intel had issues that despite a low ratio of SG&A expenses to gross profits, because of high R&D costs, the company had its economics reduced to merely average. Yet if Intel stopped doing R&D, the company would be obsolete with 10 years or less. So, as a rule, Buffett steers clear of companies with consistently high SG&A expenses. Buffett also warns that an investor has to check if a competitive advantage may be due to a company's expiring patent. Technological advancements can also be replaced. Also remember that new technology requires the expensive creation of new sales programs and administrative costs. In the book, Buffett provided the example of Merck that had to spend 29% of the company's gross profit on R&D and 49% of gross profit on SG&A expenses. Combined, they consumed 78% of Merck's gross profit. Pretty scary. Moody's, the bond rating company, per Buffett's book, held no R&D expenses and on average spent only 25% of gross profits on SG&A expenses. Coca-Cola had no R&D and spent only 59% of gross profits on SG&A costs. CODX $1 million R&D costs during 2017 were enormous compared to a gross profit of $7,360. And again, the ratios continued to be terrible until 2020. The current trailing 12 months reflects R&D costs of $8.9 million as 11% of gross profits. Again, an investment in Co-Diagnostics would mean an investor is taking a bet that these improved results could continue. This makes this investment in this area questionable regarding if CODX could make you super rich. But first, before we continue, please remember to share this video with others so that they can learn these techniques to becoming super rich also. Next, we need to check Co-Diagnostics depreciation. Buffett explains that machinery and buildings wear out over time and are reflected as depreciation on an income statement. The yearly depreciation amount is the portion of the asset that has been used in the company's business activities over the year or quarterly period. Companies with a competitive advantage have lower depreciation costs as a percentage of gross profit than companies that have intense competition. Per Buffett, Coca-Cola's depreciation was running about 6% of gross profits, Procter & Gamble's at 8%, but General Motors, with lots of tough competition, realized a depreciation of 22% to 57%. CODX depreciation of $231,000 for the current trailing 12 months months is 2.8% of the 80.4 million gross profits. But again here, the ratios for previous years from 2017 to 2019 were very poor, with a 64% ratio in 2019. Next, let's look at ways to analyze a company's debt load through interest expense to find out if Co-Diagnostics is a company that has the potential to make you super rich. Buffett explains in the book that companies with high interest payments relative to operating income are in a fiercely competitive industry. Buffett gave the example that Procter & Gamble, with low competition, held a mere 8% of operating income as interest costs. But Goodyear, in a competitive capital-intensive tire business, had to pay an average 49% of operating income in interest payments. Alternately, there are some companies that, although they have excellent business economics, have been saddled with huge acquired debt when the company was bought in a leveraged buyout. Warren Buffett has also searched for companies with a durable competitive advantage that have interest payouts of less than 15% of their operating income. But this varies by industry, as Wells Fargo Bank pays out approximately 30% of operating income in interest payments. And this bank is a AAA rating from Standard & Poor's. The investment banking business on average makes interest payments of approximately 70%. Warren Buffett looks for the company with the lowest ratio of interest payments to operating income for a competitive advantage. Let's check if Co-Diagnostics is suffering from debt and high interest payments as a ratio to operating income. The company's operating income was negative for 2017 through 2019, so obviously the ratios would be very poor. But with the great improvement in operating income for 2020 and the trailing 12 months, Co-Diagnostics appears to have no interest payments at the present, which is great news. Buffett also notes that gain-loss sale assets are a one-time event that should be ignored related to a competitive advantage. And I didn't see an entry for these items on the CODX income statement. Buffett also compares a company's income before tax, after all expenses have been deducted, but before income tax has been subtracted. American corporations have to pay taxes on their income, which at the time the book was written was approximately 35% of a company's income. In 2021, the average for combined federal and state taxes is about 25.8%, because some states have no corporate taxes and other states range up to 11.5%. This tax is reflected as income tax paid. Buffett warns that companies can fudge on their numbers, so he recommends to double check and take the pre-tax operating income, then deduct the current 25.8% from it. If this 25.8% doesn't equal the amount the company reported as income taxes paid, start asking questions. Now let's check Co-Diagnostics pre-tax operating income for 2020. Before 2021, the company was losing money, so the 25.8% income tax would not apply. In 2020, Co-Diagnostics operating income was $41.6 million, and they show their tax provision as $90.5 thousand, which isn't anywhere close to the 10+ million that would be equal to 25.8%. So as Buffett recommends, let's do some digging. I found that a note 9 in the financial statements you see here reflects that CODX deferred $547,224 of income tax that was not included in the annual report summary number. This is still much lower than what it should be. Then I found a second note 9 for taxes 1 in the annual statement, which you see here, that lists federal, state, and other tax benefits for a total of $9.8 million. This gets us to the 10 million plus income tax number that I was looking for. So the 2020 operating income of $41.6 million appears to be correct. Buffett's book also stresses that a company's net earnings should show a historical upward trend, and that here consistency is key. To indicate a durability of competitive advantage, lacking a smooth upward trend is okay. We look for historical average. You can see here that Co-Diagnostics EBIT, which here is the same as net income numbers, reflect a gradually decreasing loss for 2017 through 2019. Finally, in 2020, the company realized a net income of $42.5 million. I do believe that Buffett would want to see positive numbers for all these years. So here, investing in Co-Diagnostics would again be a gamble that the new positive trend can continue. We are still unsure whether this is a company that could make you at some point super rich. Buffett stresses that companies' share repurchase programs can throw off historical per-share earnings, but I didn't see any evidence of Treasury shares or a stock repurchase program in Co-Diagnostics' financial statement. Buffett emphasizes the importance of the company's stock repurchase program to increase the value per share for current shareholders. But since Co-Diagnostics has no Treasury shares, we will skip this part. A company's shares repurchase program can increase the per share earnings view, though, even though it hasn't actually increased. Therefore, Buffett recommends that we look at net earnings versus the per share earnings for a more accurate view. Co-Diagnostics would only have a favorable ratio in 2020. Here, the net earnings or EBIT of $42.5 million are 57% of the 2020 $74.5 million revenues. This will be fantastic if CODX can show a continued trend. Go here to view the second half of this Co-Diagnostics Warren Buffett analysis for the final details and my recommendation in my Warren Buffett Super Rich Stocks playlist. I'd love to hear your comments about Co-Diagnostics, the Warren Buffett investing approach, or any other stocks that you're liking right now. Also, go to the link in the description below that'll take you to my website, 60 Perfect Wealth, where you can sign up for our newsletter and get notified before these videos come out.